We are now going to look at the VAT implications for transactions between connected persons. Now, connected persons, this is when there's some sort of relation between people. It might be that they're shareholders or family members or so forth. We'll look at a couple of connected persons now. But the risk with this is that these people, because they are connected to each other, they can somehow manipulate transactions in order to avoid or decrease the amount of tax that should be due by them. So the Income Tax Act as well as the VAT Act have provisions on connected persons, and you need to always be on the lookout for those in tests and exams because of the implications. Now, a connected person is discussed in Section 1 of the VAT Act, and they tell us that these people are connected persons. So they say a natural person, the connected persons of a natural person. So if you and me, we're natural persons. So who would be our connected persons? It would be any of our relatives. Mother, father, siblings, grandparents. The estate of a relative or a trust where the relative is a beneficiary. So if there's a trust and your child is a beneficiary of the trust is a connected person to you. The estate, so when you pass away, you stop existing and your estate starts existing. So if Mr. X dies today, Mr. X doesn't exist, but there's Mr. X's estate. That's a separate legal person. The estate of a relative, so your mother's estate, for example, is considered a connected person. If you are a trust, who are your connected persons? Any person that is a beneficiary of the trust. If you're a partnership, who are your connected persons? Any partner. If you're a CC, any member. And if you're a company, and this is the one you probably see the most often, companies, any person who holds 10% or more of the shares in your company. So them together with their spouse or minor child. And any other company which is controlled by the same shareholder. So let's say here's X Limited, and Mr. X has 100% of the shares in X Limited. If Mr. X also owns Y Limited, then X Limited and Y Limited will be considered connected persons. And then there's a comment here. We're not going to have to worry about it too much right now, but in the Income Tax Act, the definition of connected persons is a little bit different. Now, what happens when there are connected persons? So let me just explain to you very simple, quickly, what the risk is here. So let's say X Limited is a vendor, and X Limited has a 100% subsidiary called ABC Pty Limited, a small company that is not a vendor. So, ABC Pty Limited wants to buy a machine that costs $150 including VAT. So that means it is R1,000,000 ex VAT and VAT of 150,000. Now, ABC Pty Limited wants to buy this, but what is the problem here for ABC Pty Limited? They're not a VAT vendor, so they can't claim it. So what people can do then is X Limited over here, who is a VAT vendor, can go and buy this asset and claim that VAT of 150,000 rands as input, right? And then it sells this asset that it just bought for 1.1 million for R1.15, let's say. It sells it for that price to ABC Pty Limited. So it charges output tax, remember, of 15 cents. So can you see what happens from SARS's perspective? This company over here, who should not have been able to claim any input tax, now there's been input tax claimed and very little output tax paid. So this is a way that you can manipulate, as you can see, the VAT Act. So that's why we have the rules. So what does the rules tell us? The rules tells us, okay, exactly how to deal with connected persons. Now, as before, we've got a value rule and a timing rule. The value rule is in section 10.4 and the timing rule is in section 9.2a. Now, what I want you to just pay attention to what this block tells you here is you'll see the input tax and the output tax implications may be different. So what does that mean? Remember, usually, if X Limited raises output tax on an invoice of 15 rands, Y Limited, if it buys from X Limited, claims the VAT on the invoice. So the output VAT and the input VAT are usually the same. You'll see that there are differences now in this situation. Okay, so here's the value rule, which is the most important one. It tells us what to do. It says, where a supply is made, so a supply, remember, is a sale or a rental agreement, something like that, where a supply is made by a person for no consideration, so for free, or for consideration in money which is less than the open market value. So they're saying here, something is sold for free or less than open market value. And, look, very important there, guys, there's an and there, and the supplier and the recipient are connected persons in relation to each other. And, so all of these requirements must be met. So let's go through it so far. So it must be sold for less than market value between two connected persons. And here is the most important part of it, which you need to understand. If a consideration for the supply equal to the open market value of the supply had been paid by the recipient. So they say, assume that, so let me just do it like this. X Limited is the seller. Y Limited is the buyer. And another word for buyer is recipient, the person that receives the assets. Right, so when they talk about recipient, they're talking about the buyer. So they say, if a consideration for the supply equal to the open market value of the supply had been paid by the recipient, Y Limited. So they say, assume that Y Limited did pay open market value. Would he, so it'd say he would not have been entitled under section 16.3 to make a deduction for the full amount of tax in respect of that supply. So this says, the buyer should not be able to claim 100% of input tax if it had been sold at market value. Okay, so I'm going to go through it again. So what does the rule say? It says, this section will apply if there is a supply, something is sold for less than market value, between two connected persons, and if it had been at market value, the buyer would not have been able to claim 100% of input tax. Now, when is a situation when the buyer would not be able to claim 100% of input tax? For example, if X Limited sells to Y Limited, and Y Limited is not a vendor, then they wouldn't be able to claim it. Or Y Limited will use it to make exempt supplies, or something like that. As long as they would not have been able to claim 100%, so they say if you did do it at market value, would the buyer have been able to claim 100%? If not, then this section applies. Then they say, so if this all applies, then the consideration in money for the supply shall be deemed to be the open market value of the supply. So what are they saying? They say, here's the summary. If the buyer can claim 100% of the input tax, right, that's what you need to determine. So if you can claim 100% of the input tax, then section 10.4 does not apply. If this section does not apply, this means the VAT is calculated on the actual selling price. So what are we saying? We're saying if the buyer would have been able to claim 100% of the input tax, then section 10.4 does not apply, and that means you charge whatever was charged. If the buyer can claim less than 100%, then section 10.4 will apply. This means that output tax is calculated at open market value and not on the actual selling price. So this means again, if section 10.4 applies, that output tax, not input tax, is calculated at the open market value and not on the actual selling price. Part of that is input tax is calculated on actual invoice amount, so actual selling price. And that's what we say over here. Right, so this rule over here is what I explained there. Right, so that's the timing, the value. The timing rule says it shall be deemed to take place if they're connected persons, if it is goods that are removed at the time of the removal, if it's goods which are not to be removed at the time when they are made available, and if it's services at the time the services are performed. Right. So guys, basically, that's the most important. You can read through the rest of the timing rule over here.